Once again, thanks for tuning in. Holly Shields here for Calkine Media. What is a block trade? Before we get into it, please sub to our channel, and while you're at it, press that bell icon to stay ahead of the game. A block trade is the buy or sale of a significant number of securities, including a large number of bonds or equities that are sold at an agreed price between two parties. From a trader's perspective, block trading is a means to move vast amounts of securities without the market price moving. To reduce the impact on the securities price, block trades are often made outside of open markets. A block trade typically involves at least 10,000 shares or $200,000 in bonds. Thus, block trades are substantially larger than the 10,000 shares in practice. A block trade is an agreement between two parties to buy and sell a significant number of financial products, like bonds or shares, in a single transaction. Like financial derivatives such as futures and options, block trades are executed through a privately negotiated trading mechanism. Because a block trade involves a large number of securities being bought and sold, this trading method is generally reserved for institutional investors. These investors can use a private mediator, like a hedge fund or investment bank, to block trade bonds and equities. Block trades can be bought and sold through several different mediators and divided into smaller transactions for ease and a faster contract. Block trades can be conducted through a block house, a financial intermediary, to assist investors with risk management. It can be thought of as a means for traders to sell and buy a large volume of securities without affecting market pricing. As a result, professionally trained personnel stationed in block houses can assist in managing a security's substantial trade orders while helping with the security price stable. In addition, investors can sell their equity and block trade stock simultaneously. As a result, there should be less risk of price fluctuations when employing this strategy. Futures trading, a contract between two parties that allows them to buy and sell financial products at a defined price at a future date. This relates to block trading, which works in a similar way but on a much greater size. It, along with forwards and options, is a type of financial derivative product. On the other hand, these derivatives typically deal with smaller orders of securities and span markets other than stocks, like commodities, currencies, and indices. A block deal in futures or options produces an easily recognizable contract from others in the same category. Block trades have the potential to increase market volatility. Price swings can occur because of extensive, rapid moves in a particular asset. This is not good when it encourages market volatility. For example, a hedge fund intended to sell 2 million shares of a particular business in 10,000 share increments. It's likely that the fund wants to diversify its holdings and has decided to sell that asset in favor of another. In the open market, however, 2 million shares would be available for purchase all at once. This could drive the stock price down since the market interprets this as weakness in the underlying stock, causing market volatility and incorrect stock pricing. Now that you're up to speed, check out some of our other videos to boost your financial IQ. And if you like this info, please give us a like, comment, and a share. For regular updates and info, log on to our website at calkinemedia.com. This has been Holly Shields for Calkine Media.